So let's get going again. So you've seen some of the charts I was pointing to. Let me give you a bit of a summary as to what I was referring to there. Now, basically, we've had a bit of a sell-off last week. We've pushed into what I would call the kind of cliff edge, and so far we've not fallen over the cliff. That cliff for me quite well defined in the S&P 500, and it's 1800. They're sort of 1800 to 18, maybe more specifically sort of 1820 kind of area. It's some pretty hefty support, and we did dip down into the lowest in 2 years, thereabouts in the S&P 500 last week, but we've rallied pretty strongly back. Now, if we look over to these other charts we were just looking at before, we can see that similar things have happened in Europe. Now, we've dipped below the 200-week moving average in Germany, but we've pulled off, before we reached this low from October 2014, we've reacted before we got there. Still a chance we can dip down, though. That's my base case scenario, that we probably do get down there. But at the moment, seeing a bit of a pullback off the lows, and we've kind of held this support here, which I had on the chart. We've obviously dipped through it, but we've closed back above it, and kind of reacted from this open to this lower candlestick here. Now, looking at the FTSE as a basis for comparison, you can see we did make fresh 3-year lows, but have seen a strong bounce back, and that's continuing through today. Part of what really sent us lower last week was this sell-off in financial shares. If you pull up a chart of looking at the financial sector versus the FTSE 100, I don't have a chart for the financial sector right here, but the general idea is that it's been massively underperforming the general benchmark, and part of the reason is that we've been moving towards lower interest rates, and obviously recently kicked off really by the Bank of Japan. We've seen a shift into negative interest rates, and Japan's 10-year yield, so the yield on their 10-year debt, turned negative. So if you want to borrow for the next 10 years in Japan, you actually have to pay for the privilege. So if you want to buy bonds for parking money in a safe area to earn an investment, you're actually paying for that privilege. So things have got pretty distorted, and that's not a great environment for banks, because they typically try to borrow at the long end and then lend to you at the short end, making the interest rate difference a bit difficult when it's negative at the end they want to borrow from. It just confuses things. So today we're getting a bit of a bounce back. There's just been a few positive news items out of the banking sector. Today's example is that HSBC is staying in London. We had some decent earnings from Commerzbank at the end of last week. JP Morgan Chase's Jamie Dimon buying, Morgan. Yeah, JP Morgan's, I was going to say Morgan Stanley, but it's too many Morgans. The CEO has bought $25 million worth of stocks, showing some faith in the sector. So a few things supporting the bank shares. They're lifting the FTSE today. And Chinese markets have come back, but they haven't dramatically sold off to match the sell-off of last week, because obviously looking at those charts we just saw, we've actually come back quite a bit off the lows. So not as much, if you take the aggregate of it, not so much reason for China to sell off dramatically. And probably the biggest news over the weekend was the interview release from the People's Bank of China governor, just saying that essentially that there are no plans to drastically devalue the yuan. But you can sort of see that from what they've been doing. They've been massively intervening to sell dollars and buy up the yuan to keep its value. They're trying to keep the yuan constant against a basket of currencies, and he sort of dismissed the dollar volatility as just a sort of a byproduct of that. Obviously, there's a lot of big hedge funds out there who are actively shorting the yuan in the belief that China's slowdown means that their currency should be worth less. And that's a large part of what's caused turmoil at the start of the year. If the yuan can stabilize, perhaps even, excuse me, appreciate a bit over the next week or so. I think that would improve sentiment, and that could be a reason to build a bit of a base off that 1800 level in the S&P and other global markets. Now, I think I mentioned in this recording that Mario Draghi speaking at 2 p.m. GMT today. Have a quick look at the euro. Interestingly, with the euro in the massive sort of sell-off that's taken place, the euro has rallied. Largely, the economic data for Europe hasn't been fantastic. German industrial production saw a surprise drop. Multiple other indicators that weren't too impressive. But nonetheless, the euro picked up and declined at the end of the week, matching the jump in equities. And I think it's basically explained by the idea that in these kind of risk-off market environments, European investors are pulling their money back into Europe from overseas. So, what's the situation here? Well, if we pull the charts out a bit, we see that we're in this range. Now, obviously, now that we've broken out, the opportunities for going long are slightly diminished, but still, you would think that eventually the default in this kind of range-bound environment is probably to try and re-challenge 115 again. Or I have this line on there which I think connects a few of the peaks quite nicely. It's about 114.60. That, I think, would be the target, but we've seen a bit of a drop back off the peak of last week. Chance in the shorter term for a bit of a drop back. I think 110 is probably the real line in the sand. That's what we were bumping up against, 110, and we turned into this triangle pattern, and we got the dramatic breakout. So we'll have to see what Mr. Draghi has to say later today. One of the interesting things about what's happened recently, and it happened, I think it wasn't necessarily. It might have been actually the Wednesday. I can't remember if it was the Wednesday or the Thursday. But basically, Mario Draghi and Kuroda, the Bank of Japan governor, both one of them announced that there's a good chance of easing in March. That was Draghi. The other announced the negative interest rates. But the yen and the euro did precisely the opposite of what they would have intended, i.e. going up, not particularly helping their exporters. So we'll have to see what the reaction is to Mario Draghi. If the euro jumps again, he's really lost a lot of influence, and that was one of the main catalysts for European stock markets rallying, was ECB stimulus and Draghi talking up the prospect of more stimulus. If he's lost that ability, it takes away a lot of the kind of catalyst for why European stocks are rising in the first place, which is evident enough because we're now pushing into multi-year lows. Looking at sterling, sterling has the most on the economic data calendar. It's sterling that kind of dominates this week. So stock kicks off tomorrow when we've got inflation data out. CPI obviously meant to remain at pretty low levels given the drop in oil prices, but nonetheless CPI year over year is expected to tick slightly higher to 0.3% from 0.2% in December. Then so we have the FOMC minutes, was obviously going to impact all dollar pairs on Wednesday, but we do have, before that, we've got the unemployment rate and the average earnings data on Wednesday. And we round things off for the UK with retail sales on Friday. So what we're looking for here, kind of technically, is off this economic data is reasons to judge whether this rebound off the lows in the pound is sustainable. So what we've seen is a couple of dojis showing indecision right above the 140 mark, the 140 handle, a big bullish breakout. Then we've pulled back from this peak from sort of April 2015, come back, re-challenge the breakout area, and close back even. So at the moment, to me, it is on the bullish side. We haven't broken to the top side, but that is quite significant support. that held for a long time. We've broken it, we've retested it, we've come back and challenged, but there's a chance we can push through. But if we can't, then that's, then the default. This really is the line in the sand for me, this sort of 146.30 type area. If we can't push through there, that to me is probably rolling down beneath 140. But if we can close a week up through there, then maybe this decline is over. So we've successfully challenged the breakout area, but we've not successfully broken above that previous support and resistance. So that's the next, as I said, line in the sand, really. Dropping down slightly to the daily chart. Here you can see that kind of resistance building up right beneath the 146 level. And it's been actually consolidating with pretty narrow opens and closes right in at 145. So a bit of indecision about where this is going to go, but I think by the end of this week we'll have a much better idea. Not only have we got the economic data that I just mentioned, but actually a quite decent chance, supposedly, that PM David Cameron will have some sort of deal from Europe and potentially set the date of the referendum. Now, some of the most dramatic moves that we've seen recently have come from the yen. This is the weekly chart. This is fairly textbook. We've got declining momentum. We've got a trend line here that first broke. We've got a run down to a fairly well-defined support at 116, a bounce, a retest of the broken trend line, and then just plummeted down right towards the next logical area of support that have actually rebounded since getting there. So to me, this is pretty much a topping pattern here. I mean, this is a sort of pretty roughshod head and shoulders reversal pattern. And, there's a chance a few people could get caught offside around 116, but to me, 116 is pretty tough resistance now. It was strong support. It should be strong resistance on the way back up. So if we can get anywhere close to it, that to me would be an area of possible weakness for dollar yen. Dollar yen correlates pretty well to stock market, so we'll have to see, if there's a massive return to some risk-on sentiment. If the Bank of Japan maybe managed to convince us they're able to do more than just the negative rates that they've done so far, perhaps more quantitative easing, then that could all work together to help dollar yen and then equities move higher. Now, crude, I think Brent is the most, WTI is actually the most obvious bottom, but I was looking at Brent today in the chart forum. But here you can see, circled here, basically a fake out to the bottom, and then just a nice rally up to the support, and then we've opened above that today, and we're pushing higher. So the next logical stop probably would be this declining trend line here, which kicks in around 31. And then I can probably get into a little bit more detail on Brent since that's what I updated today. And you can see that Brent's actually slightly out.